Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 392 on September the 12th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on aTyr, Pharma Inc., American Airlines, and Hewlett Packard, and we discuss three new trades on Bitfarms, Cipher Mining, and Serve Robotics. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets ended the week higher on a mix of news and emotions. The Dow Jones Industrial Average grew 433 points, closing at 45,834 points this week. The S&P 500 index picked up 105 points, ending the week at 6,587 points. And now it's time for the topic of the week. The topic of the week is spread values. I started to hint on this topic last week, but felt like it deserved a topic of its own. Now, there's a lot of information tucked into the price of a spread. Let's assume we're looking at an option with 3 weeks left until expiration. The slightly in-the-money spread should trade for 60 to 68% of spread value. That means for a $1 spread, I would expect to see a price of 60 cents to 68 cents for the spread. The deep in the money spread should price around 75% of the spread value. So if the spread value is $1 wide, that means I would expect the deep in the money spread to be 75 cents or more. The just out of the money or at the money spread should price somewhere between 35 and 45% of spread value. The farther out of the money spread value should price between 20 and 35% of spread value. The truly far, way out of the money spread should price far less than 20% of spread values. As I'm looking for trades, I always have these ideas in the forefront of my mind. When I see in the money spreads that are pricing closer to 50 to 60% of spread value, I know the market is less certain about the spread finishing in the money, and therefore it is willing to give me a higher return if I buy it. For stocks that are very consistent and less volatile, you'll see that the in-the-money spreads are even more expensive. Now, sometimes I see out-of-the-money spreads that are pricing more like in-the-money spreads. That's always a sign to me that the market expects a large move in that direction. Rather than buck the trend, I heed the warning and make sure that I trade in that direction. As you trade spreads long enough, you pick up these sorts of priced-in pieces of knowledge. It becomes very helpful to always consider what the spread prices are telling you about price direction and about the probability of finishing in the money. So hopefully this is enough of a hint to get you started. And if you've been listening to this show for a while, there have been lots of hints along the way. Hopefully you're picking them up. If not, send me an email. So that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. We're going to start off with our covered call on aTyr Pharma Inc., symbol A as in Alpha, T as in Tango, Y as in Yankee, R as in Romeo. At the time, the stock was trading for $5.61 per share. I looked at buying that stock and selling the September 6 call at $2.40, hoping for a return of 49.73% in 2 weeks. Well, shares of aTyr Pharma gained 41 cents, ending the week at $6.02 per share. The call option that we sold gained 55 cents, leaving us with a net loss of 14 cents if we were to try to close the trade out right now. However, we know that with stock above $6, we are winning on this trade. Not only will we keep the $2.40 we collected for selling that option, we also will keep the 39 cents of the stock gain, leaving us with a nice 49.73% return on capital for a 2-week trade. Again, this is contingent upon stock expiring above $6 per share on this upcoming Friday, September the 19th. If the stock does not expire at a level that removes our stock, we will look to sell another at-the-money call option in the month of October to further extend our profit on this trade. Nice work so far on this one. Next up, we have a credit spread on American Airlines, symbol A as in Alpha, A as in Alpha, L as in Lima. At the time, the stock was trading for $13.09 per share. I looked at selling the September 13, 12-half put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. Now, shares of American Airlines lost 18 cents, ending the week at $12.91 per share. The out-of-the-money put spread that we sold is now at the money, with the stock price being slightly below our short strike. The stock price is still above our break-even point, which means that this trade is still in a profitable range for us. However, it's best to be prudent at this point. I might give this trade a day or so before deciding whether to close it out for a slight loss or not. It's not worth creating the iron condor by selling the upper call spread because those higher strike call spreads don't have much value with 1 week left until expiration. So this trade is definitely on high alert for the next few days. Right now, I can exit the trade outright for a 4-cent loss. If the stock doesn't rally soon or simply start ticking higher a little bit, I'm happy to hit the exit door. And then our final trade from last week was that debit spread on Hewlett Packard, symbol H as in hotel, P as in Papa, E as in Echo. At the time, the stock was trading for $23.53 per share. I looked at buying the September 23 half call spread for 32 cents, hoping for a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Well, shares of Hewlett Packard jumped $1.20, ending the week at $24.73 per share. The in-the-money call spread that we bought is even more in the money. We will capture our full return of 56% and a quarter if stock expires above $23.50 per share on Friday. Now, this trade is working out as planned so far. If I had the opportunity to exit this trade early and lock in a significant portion of my expected profit, I'd probably consider doing it. Let's just see how this upcoming week goes. Hey, we're only 5 days away until expiration. So that's it for the review of last week's trades. We are entering expiration week for monthly options in the month of September and also for futures. We will also have an interest rate decision by the Federal Reserve Bank on Wednesday. Now, I'm expecting some price volatility in the second half of the week, regardless of which way they decide on that interest rate decision. Now, all new trades on today's show will use the October 17th date for monthly options in October. So let's dive in with our covered call. I'm looking at Bitfarms Inc., symbol B as in Bravo, I as in India, T as in Tango, F as in Foxtrot. The stock ended the week at $2.25 per share. I'm looking at buying that stock and selling the October 2-half call at 39 cents. That could give us a return of 28.44% in 5 weeks. Now, you enter this trade by buying stock for $2.25 per share and selling the October 2-half call at 39 cents. This trade makes the most money if stock prices finish above $2.50 per share. The break-even price on this trade is $1.86 per share. In real terms, the stock purchase will require $225, and you'll collect $39 for selling the option. Next up, we have a credit spread on Cipher Mining Inc., symbol C as in Charlie, I as in India, F as in Foxtrot, R as in Romeo. Stock ended the week at $10.84 per share. I'm looking at selling the October 10-9 put spread at 39 cents. That could give us a maximum possible loss of 61 cents per spread. Now, you enter this trade by selling the October 10 put at $1.10 and concurrently buying the October 9 put for 71 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $10 per share. The break-even price on this trade is $9.61 per share. In real terms, you'll receive $39 per spread that you sell and have $61 at risk. And our final trade for this week's show is going to be a debit spread on Serve Robotics, symbol S as in Sierra, E as in Echo, R as in Romeo, V as in Victor. The stock ended the week at $12.13 per share. I'm looking at buying the October 11-12 call spread for 55 cents. That could give us a maximum gain of 45 cents, or that would be an 81.82% return in 5 weeks. Now, you enter this trade by by buying the October 11 call for $2.10 and concurrently selling the October 12 call at $1.55. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $12 per share. The break-even price on this trade is $11.55. In real terms, you'll pay $55 to enter this spread, and your maximum gain is $45 per share. It's a nice high-risk, high-reward trade for the end of today's show. So hope you guys are having a great weekend, and I hope that you take some time to just relax and get ready for a great week up ahead. All right, have a wonderful weekend, and as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.